Hey everyone, welcome to the First Market Pulse Weekly Deep Dive. Every day I bring you a 60-second market close. Once a week I want to slow down and unpack the one idea that actually mattered, the thing that, if you understand it, makes you a sharper investor for years, not just this week. So, let's start with what happened. This was a rough week. All three major indexes finished lower, with the Nasdaq down about 2%, its worst week in a month. But here's the thing I want you to notice. The sell-off was not broad. It was surgical. On Thursday alone, the 7 biggest tech companies lost nearly $800 billion in a single day. Meanwhile, chip stocks actually rose. And at the center of it were two names, Alphabet, Google's parent, and Tesla. Both reported earnings. And this is where it gets interesting, because on paper, Alphabet's results were great. Revenue up 24%, Google Cloud up 82%, the largest quarterly profit in the company's history, and the stock fell 7%. So that's our question for today. How does a company post record profits and crash? Here's the single most important idea in investing, and almost nobody explains it clearly. The price of a stock today already contains what everyone expects to happen. When a company reports earnings, the stock doesn't move based on whether the results were good. It moves based on whether they were better or worse than what was already expected. Let me give you an analogy. Imagine a student everyone knows is brilliant. Everyone expects an A+. Report card comes, a regular A. The A is a great grade, but the student fell short of the expectation and people are disappointed. Now imagine a student everyone expects to fail. Same A shows up. Everyone's stunned, and that student gets celebrated. Same grade. Opposite reaction, because the market never trades on the grade. It trades on the grade versus the expectation. That's exactly what happened to Alphabet. 82% cloud growth is an A+ in isolation, but the market had already priced in an A+. So a great quarter wasn't good enough because great was already the expectation. Here's the second layer. And this is the part that made this specific week matter. For years, the scorecard for a big tech company was simple. How much profit did you make? These companies were money machines. But this quarter, the market quietly switched the question. It stopped asking how much did you earn and started asking how much are you spending and will it ever pay off? Because Alphabet said it would spend up to $205 billion next year building AI data centers, far more than expected. Which brings us to the phrase that actually spooked Wall Street, negative free cash flow. Let me explain it simply. Profit is what's left after the costs of running the business. Free cash flow is different. It's the cash actually left in your pocket after you've also paid for big long-term investments like AI data centers. You can be profitable on paper and still have negative free cash flow if you're spending more building for the future than you're bringing in right now. And this week, two of the largest companies on earth, Alphabet and Tesla, both reported negative free cash flow in the same quarter. For 20 years, the entire case for these giants was that they generate mountains of cash. This week, they didn't. They poured it all into an AI bet that may not pay off for years. And the market said, wait, I'm not sure I'm being paid to wait. That's the 7% drop. Now, remember the strange thing from the recap? Chip stocks rose while big tech fell. Here's why, and it's the elegant part. Alphabet's $200 billion spending plan is a cost to Alphabet, but to the companies selling the chips and servers, it's revenue. The exact same number that terrified Alphabet's investors thrilled the chipmakers' investors, and when Intel reported and also raised its spending, the market rewarded it because Intel could point to 25% revenue growth to justify the spend. The lesson isn't that spending is bad, it's that the market funds your spending only as long as it believes the growth will follow. So why does all of this matter for next week? Because next week is the exam. On Wednesday, two things happen. First, the Federal Reserve announces its interest rate decision at 2 p.m. Eastern. Markets expect no change, but with oil having spiked toward $100 this week, every word about inflation will be scrutinized. And that same Wednesday, after the close, Microsoft and Meta report. Then Thursday, Apple and Amazon, 4 of the Magnificent 7, back to back. And every one of them now knows exactly which number the market is going to look at first. Not revenue, not even profit, spending, and whether the growth is there to justify it. So when Microsoft reports, don't just look at whether they beat. Look at their capital spending and listen to whether management can convince investors the AI build-out is paying off. If they can, the stock can rise on a worse quarter. If they can't, they could fall on a great one, exactly like Alphabet. That's the pattern. Now you can watch it play out in real time. That's your weekly deep dive. If this helps something click, subscribe. I do this every weekend, plus a 60-second market close every weekday. And remember, everything here is for education only. It is not investment advice. I'll see you at Monday's close.